What if I told you that chasing the highest dividend yield could actually hurt your long-term investments? It's one of the most common mistakes new investors make, focusing only on yield and missing the bigger picture. The truth is, the perfect dividend strategy isn't the same for everyone. A 25-year-old and a 55-year-old shouldn't be building identical portfolios because your age and time horizon matter far more than you might think. In this video, I'll show you why a one-size-fits-all approach to dividend investing falls short and how understanding your own timeline can change everything. We'll also break down the Rule of 72, a simple tool that reveals how compounding can work for or against you, depending on your strategy. By the end, you'll know exactly how to build a dividend portfolio that fits your goals and your stage of life. So why do so many investors get stuck with the wrong strategy in the first place? Many investors fall into the trap of following generic dividend strategies, believing there's a universal formula that works for everyone. It's easy to see why. There's no shortage of advice pushing either high yield or high growth approaches, and both can sound convincing. But the reality is that these strategies ignore the most important piece of the puzzle: your personal time horizon. Let's look at why this matters. High-yield investments, for example, are often marketed as the quickest way to build passive income. The appeal of a 6 or 7% yield is obvious. It promises regular, sizable payouts. But what's often hidden is the trade-off. Companies or funds offering higher yields might not be reinvesting enough in their own growth, which can limit future gains. Some high-yield stocks or ETFs may even be compensating for underlying financial instability. If you're early in your investing journey, locking into these income streams can mean missing out on years of compounding growth that could dramatically increase your future wealth. On the other hand, some investors are told to focus only on dividend growth with the idea that wealth will build over time as dividends increase. This approach has its own risks. For someone nearing retirement, a portfolio that prioritizes only growth may not provide enough income when it's needed most. The power of compounding is incredible, but it takes time to see the full benefits. If your investment horizon is short, waiting for dividends to grow may not be practical. The core problem with a one-size-fits-all approach is that it assumes everyone's needs are the same. But the timeline for when you'll actually use your investments changes everything. Younger investors have decades for their portfolios to grow and compound, making dividend growth a powerful ally. The Rule of 72 helps illustrate this. If your portfolio grows at 10% annually, it doubles in just over 7 years. But if you're only getting 1% growth, doubling your money could take a lifetime. For younger investors, prioritizing growth, even if the starting yield is lower, can lead to much greater income in the future. Let's put this into perspective with a single example. Imagine you have two portfolios. The first pays a 6% yield, but that yield never increases. The second starts at a 3% yield, but the dividends grow by 10% each year. In the early years, the higher yield portfolio seems like the obvious winner. But as time goes on, the compounding effect of dividend growth takes over. After a decade or more, the income from the growth-focused portfolio surpasses the flat yield option, and the gap only widens from there. This demonstrates why growth is so important for long-term investors. However, not everyone has the luxury of waiting for compounding to do its work. If you're approaching retirement or need to start using your investment income soon, high-yield strategies can make sense. Immediate income becomes a priority, even if it means sacrificing some future growth. This is where generic advice fails. It doesn't account for the critical difference between someone investing for the next 30 years and someone who needs income within 5. The right approach depends on your unique timeline. If you have decades ahead, the compounding effects of dividend growth are invaluable. If you need income soon, higher yields might be necessary, but you still want to avoid sacrificing all potential for growth. Even with the same portfolio, your priorities will shift as your time horizon changes. Instead of searching for a universal dividend strategy, focus on what fits your timeline. Consider how long your money will remain invested before you need to draw from it. High-yield ETFs like QYLD or JEPI might make sense for those seeking steady monthly income now, while growth-oriented funds like VGT or SPY might be better for those with more time. The key is to match your approach to your needs, not to follow a generic rule. Understanding your time horizon is the missing piece that can transform your dividend investing strategy. When you align your portfolio with your personal timeline, you avoid the pitfalls of one-size-fits-all advice and set yourself up for better results. With that foundation in place, let's look at what happens when your investment timeline is short, whether you're just a few years from needing income or already planning your withdrawals. For those who need their investments to start working for them soon, the 0 to 5 year strategy is all about balancing immediate income with the need for some growth. This approach is designed for investors who expect to rely on dividend payments to cover living expenses in the near future. The primary goal shifts from maximizing long-term growth to ensuring a steady, reliable income stream that won't run dry or lose value to inflation. When your timeline is short, it's tempting to chase the highest yields available, but focusing only on yield can expose you to unnecessary risks. High payouts sometimes come from companies or funds that aren't financially stable or that sacrifice future growth for today's income. If you lock yourself into these, you may find that your income can't keep up with inflation, or worse, that dividends get cut just when you need them most. The right balance is usually found with a portfolio that targets a 4 to 6% yield and seeks out 5 to 7% annual dividend growth. That way, you get the income you need now, but your payments can still grow over time to help you keep pace with rising costs. To achieve this, you'll want to build your portfolio around a mix of carefully chosen ETFs. Each brings something different to the table. VYM and SCHD are excellent starting points. VYM focuses on high-quality, established companies with a history of paying dividends over 2.61% yield and 3.59% annual dividend growth. SCHD, meanwhile, provides a bit more growth potential, pairing a 3.75% yield with an impressive 10.87% growth rate. Both give you a solid foundation of income while allowing for increases in the years ahead. Adding diversification is also important. VNQ, a real estate ETF, gives you exposure to REITs, which are legally required to pay out most of their income as dividends. This can boost your portfolio's yield, but keep in mind that REIT dividends are taxed as ordinary income. For smaller portfolios, the Section 199A deduction can help offset some of this tax burden, but for larger portfolios, it's often better to hold VNQ in a retirement account to maximize tax efficiency. Covered call ETFs like QYLD and RYLD are popular with income-focused investors because they generate high monthly payouts. QYLD, for example, can yield over 12% annually. These funds do this by selling covered call options, which produces steady cash flow but limits the potential for capital appreciation. Over time, this can mean lower total returns, and the income is typically taxed as ordinary income. For those who need immediate, reliable cash flow and are less concerned with long-term growth, these ETFs can play a role, but they should never dominate your portfolio. If you want a blend of current income and growth, DGRO offers a smart middle ground. With a 2.18% yield and a 7.62% dividend growth, it's built around companies with a strong record of increasing dividends, which helps ensure your income remains sustainable. JEPI is another useful addition. It uses equity-linked notes to provide steady monthly income while smoothing out some of the market's ups and downs. This can help reduce the anxiety of market volatility which is especially important when you're counting on dividends to cover everyday expenses. Let's put this into context. Imagine you're a few years away from retirement and need your investments to start paying you soon. You need enough income to pay the bills, but you don't want to drain your principal or see your purchasing power erode. A portfolio built around SCHD, VYM, and JEPI provides a stable stream of income, while smaller allocations to VNQ and DGRO add both diversification and a measure of growth to help keep up with inflation. Including some QYLD or RYLD can boost your monthly payouts, but always be mindful of the trade-offs in growth and tax efficiency. Building this kind of portfolio isn't about trying to time the market or making big, risky bets. Instead, it's about steady, consistent investing, dollar cost averaging into these ETFs, and letting the income build up over time. This helps smooth out the ups and downs of the market and ensures you're always putting your money to work no matter what's happening in the headlines. Ultimately, the 0 to 5 year strategy is about creating a reliable income stream that can support you now while still giving your portfolio a chance to grow and adapt. As your horizon extends, your priorities will shift, and your strategy will need to evolve to capture the greater opportunities that come with a longer timeline. For investors with a 10 to 15 year time horizon, the strategy shifts toward maximizing growth while still keeping dividends in the picture. This is the stage where patience becomes your best asset. Instead of chasing high yields for immediate income, you start to prioritize consistent dividend growth and capital appreciation, knowing that the real payoff comes later. The focus is on building a portfolio that acts as a compounding machine, setting the stage for financial independence down the line. The trade-off here is clear. You'll accept a lower starting yield, typically in the 2 to 3% range, in exchange for the potential of double-digit dividend growth. At first glance, this might seem like you're giving up too much income, but the real magic happens as those growing dividends are reinvested year after year, allowing compounding to work in your favor. Over a decade or more, this approach can lead to a much larger income stream than what a high-yield, low-growth portfolio could provide in the same period. The longer your timeline, the more you can afford to sacrifice current income for future growth, as long as you maintain some dividend growth in your holdings. Tax efficiency becomes especially important in this stage. Since you're likely to hold your investments for many years, the way your dividends are taxed can make a big difference in your net returns. Qualified dividends, those paid by most U.S. companies and certain ETFs, are taxed at a lower rate than ordinary income, which helps you keep more of what you earn. That's why the recommended ETFs for this strategy, SPY, VYM, SCHD, and DGRO, are all designed to deliver qualified dividends, making them suitable for both taxable and retirement accounts. Each ETF in this portfolio serves a specific purpose. SPY, which tracks the S&P 500, is the growth engine. While its yield is just 0.47%, it provides exposure to the largest and most successful companies in the U.S., delivering steady capital appreciation and helping your portfolio grow in value. VYM brings in a dividend focus, investing in companies with high, sustainable payouts. Its 2.61% yield adds a layer of income, while the stability of its holdings helps anchor your portfolio. SCHD stands out by bridging the gap between growth and income. With a yield around 3.75% and more than 10% annual dividend growth, it gives you the best of both worlds: solid current income and the potential for that income to increase meaningfully over time. SCHD's focus on high-quality companies with strong records of dividend growth ensures that your portfolio remains resilient, even as markets shift. DGRO rounds out the lineup as a dividend growth hybrid. Its 2.18% yield and 7.62% dividend growth rate make it a strong candidate for those who want dependable payouts with the potential for rising income. DGRO only includes companies that have boosted dividends for at least 5 consecutive years, so you're investing in businesses that prioritize rewarding shareholders. Picture a 35-year-old professional who's focusing on building wealth for retirement, but wants to see progress along the way. They're not so close to retirement that they need to prioritize income, but they're also not so far away that they can ignore stability. For someone in this position, a portfolio split among SPY, VYM, SCHD, and DGRO offers a balanced approach. Regular contributions and automatic dividend reinvestment can accelerate the compounding effect, turning small, consistent investments into significant wealth over time. The longer you stick with this plan, the more you benefit, not just from rising share prices, but from dividends that grow and multiply. One of the key advantages of this strategy is its tax efficiency. By focusing on ETFs that pay qualified dividends, you reduce your tax burden, especially if you're investing through a taxable account. This leaves more money in your portfolio to reinvest, further amplifying your returns. And by avoiding REITs and covered call ETFs at this stage, you keep your portfolio streamlined and focused on growth. The heart of the 10 to 15 year approach is consistency. Dollar cost averaging into these ETFs, reinvesting every dividend, and resisting the urge to chase short-term trends will help your portfolio become a true compounding engine. Over time, this approach can replace a significant portion of your salary with dividend income, setting you up for real financial independence. As you watch your portfolio grow and your dividends increase year after year, you might start to wonder what happens if you have even more time on your side. That's where the next level of compounding comes into play. If your investment horizon stretches more than 20 years into the future, your strategy is all about maximizing growth and letting compounding do its work. This is the stage where you can afford to look past immediate income and instead focus on building a portfolio that grows, reinvests, and multiplies year after year. The goal isn't just to collect dividends now, it's to set yourself up for a future where your portfolio generates substantial passive income, possibly enough to replace your salary. The numbers behind this approach are compelling. Using the rule of 72, you can see how powerful compounding becomes over decades. For example, an investment with a 10% annual return doubles about every 7 years. Over 20 or 30 years, this leads to exponential growth. If you instead choose a high-yield investment with little or no growth, say a 6% yield that never increases, it takes 12 years to double, and you miss out on the multiplying effect of rising dividends and capital appreciation. Over a long period, the difference between these two approaches is dramatic. That's why for a 20-plus year timeline, prioritizing dividend growth over immediate yield is the smarter move. The ideal portfolio for this strategy typically features yields between 0.5% and 3%, but with annual dividend growth rates that exceed 10%. You might earn less income in the early years, but you're planting the seeds for a much larger harvest later. Think of it like starting an orchard. Little fruit at the beginning, but with patience and time, your yield grows far beyond what you could get from a single mature tree. The longer you let your investments compound, the more you benefit from the snowball effect of reinvested dividends and rising share prices. Building this kind of portfolio means choosing ETFs that are designed to fuel long-term growth. VTI is a core holding for many investors in this category. By tracking the entire U.S. stock market, VTI gives you exposure to large, mid, and small cap companies, all for a very low expense ratio. Over the last 5 years, VTI delivered a total return of nearly 95%, showing how broad market exposure can drive significant gains without the need to pick individual winners. SPY, the well-known S&P 500 ETF, is another strong foundation. Its yield is modest, around 0.47%, but it holds the largest and most stable companies in the U.S. economy. Over time, these businesses tend to grow their earnings and dividends, providing steady capital appreciation. For long-term investors, SPY offers a balance of stability and growth potential. For those willing to accept more volatility in exchange for higher growth, VGT, the technology sector ETF, brings exposure to companies like Apple, Microsoft, and Nvidia. In the last 5 years, VGT returned nearly 140%, far outpacing the broader market. While tech can swing up and down, younger investors with a long runway can weather these fluctuations and benefit from the sector's outsized growth. DGRO adds another layer to the mix by focusing on companies with at least 5 consecutive years of dividend growth. With a 2.18% yield and a 7.62% annual growth rate, it helps bridge the gap between current income and future compounding. SCHD, meanwhile, targets high-quality companies with a strong track record of dividend growth, offering a 3.75% yield and annual growth above 10%. These ETFs provide a steady base of growing income, making them ideal for building a future income stream. Imagine a 25-year-old just starting out, investing regularly with a plan to let their money grow for decades. By focusing on these growth-oriented ETFs and reinvesting every dividend, they harness the full power of compounding. Small, consistent contributions made today can turn into a portfolio capable of producing life-changing income by the time retirement arrives. The key is consistency, dollar-cost averaging, reinvesting dividends, and sticking with the plan, even during market downturns. Tax efficiency also matters over the long term. Investing in ETFs that pay qualified dividends like VTI, SPY, SCHD, and DGRO helps reduce your tax burden in taxable accounts. For retirement accounts, you can afford to include tax-inefficient holdings like VNQ or covered call ETFs, since those dividends are sheltered from current taxes. The most important insight for the 20-plus year strategy is that time is your greatest asset. By sacrificing some immediate yield and focusing on growth, you give compounding the opportunity to work in your favor. This approach can transform small, regular investments into a portfolio that supports your financial independence. As you think about which strategy fits your own timeline, keep in mind that the real secret isn't about chasing the highest yield. It's about choosing an approach that matches your goals and your stage of life. As you consider your investment journey, remember that every stage of life brings different priorities for your portfolio. The most effective dividend strategy comes from understanding your own timeline, whether you need income soon or want to maximize long-term growth. Your approach should reflect those needs. Focus on finding the right mix of yield and growth that supports your future goals and keeps your income growing over time. If you found your timeline above, let me know in the comments which portfolio you'd choose and why. If this framework made dividend investing click for you, hit like and subscribe for more strategies on building wealth with ETFs. Remember, time in the market beats timing in the market. Align your ETFs to your horizon, stay consistent, and let compounding do the work.